What is going on, guys? Mark Berti here. In this video, I'm going to talk about investing in stocks with margin. Is this something people should be doing? Why do people do it in the first place? We're going to be talking about all that in this video. Before we do, though, make sure you subscribe to Beat the Market if you want more videos designed around investing and different strategies you can use to boost your income and appreciation. So when it comes to investing in margin, I think it's pretty obvious why people want to do it. You get to play with other people's money, you get to buy more stocks, and you get to compound your returns even more. So that's pretty much why people do it. There are certain risks associated with it. Obviously, the main one being if you buy stocks on margin and they go down, the broker doesn't really care that stocks went down. They still want the same amount of money that you borrowed from them. And the interest rates are pretty high on that money, especially if we are talking about a small amount of money. And you got to get to like $1 million in margin to have a 4% interest rate. So most people are going to be looking at like 6 to 8% interest rate per year based on that margin. Now, if you are someone who maybe you buy the stock, you do some type of covered call or you do some cash secured put and you're very in and out with it, then you're not paying 6 to 8% interest per year because you're not holding it for each year. So the way that the calculations work is if you own the stock for like one day and then you sell it, you own interest rate based on the 8% per year, but only for one day. So it'd be 1 divided by 360, multiply that by 8%, and that's your percentage of interest rate. So if you hold on to the stock for like 1 or 2 days, the interest is actually very minuscule. But, you know, if you keep doing these types of, if this is your style and you keep doing these types of trades, it does add up. It probably won't get to the full interest rate size. Like it won't be like a whole 6 to 8%, but it is something to keep in mind. Now, similarly, you may believe a stock has a lot of long-term potential and you want more shares now, but you just don't have the money to buy it now. So that is where margin can certainly come into play. The major concern, though, is you still have to pay this off. And I used to have like a margin account. I almost never play with it and I deactivated it. The reason being is that it does play with your mind a little bit. So when you do have a lot of this power, when you suddenly like, you know, your purchasing power suddenly doubles. And now it's like, oh, I have so much more money I could play with. But you have to remember it's not your money. And if the stocks go down, like, are you okay with that financially? So one of the big fears is getting the margin call. Pretty much what a margin call is your stocks hit a certain level and at certain levels, and like they've been going down a lot. And the brokers want to make sure that they get paid. They want that protection. So they are allowed to go into your account and sell whatever stocks they feel like they want to sell. They can do whatever they want to ensure they are receiving the payment based on the loan that you took from them. So let's say, for instance, you buy one stock with your whole portfolio. This is something that you wouldn't do, but I'm just giving this as an example to illustrate. You buy one stock with your money and with the full margin. If that stock goes down 50%, it's the equivalent of like your portfolio going down a full 100%. Because in the 50% scenario, like let's say $100,000 to make this super easy, and you know you had 50,000, you borrow 50,000, that's how you get there. If it goes down 50%, the $100,000 stock value now goes down to 50,000, but now you still have 50,000 in debt that you have to pay, so it goes down to zero. But similarly, in the other way, if the stock goes up 50%, since you have 2 times the shares, you actually go up 100%. So margin is very high risk, high reward. I think the only reason it would make sense to get in is if you know what you're doing, you're super confident, but also you have a way where you're confident with the way you could pay off all of that margin in a very timely manner. You know when to sell. Like, I don't think buy and hold is like a good strategy when you're using margin, because again, that stuff can really play with your mind. If you see your stock go down 5%, that's really a 10% loss. If you are fully margined, where you have all of your money like just doubly invested in all of the assets you already had. So it is something like you got to pay a lot more attention when you have margin. And that's not something I really felt like doing. And that's not something you may feel like doing either, but there is the potential for much higher returns. Some people, they actually take out margin, not just for the sake of buying stocks, but let's say that you want to buy a house and you don't want to sell your stocks, but you know that's like the only way that you're going to be able to get this house. In this case, a margin account could actually be really smart, because some of the margin money they give you can be taken out of your account and can be deposited into your bank account. So if you need some extra cash for an investment outside of stocks, like you want to buy a house or some other big purchase, be super careful with this stuff. Again, I would only recommend this for a real investment like a house. Instead of selling all of your stocks, do the margin and then chip away at the margin debt in the same way you would chip away at the mortgage. Like real estate, they make leverage super attractive because there's a 20% down payment. You pay money to get like 5 times house in value. And real estate is a little easier because, you know, you've got the 15-year or the 30-year, and you could have a tenant like completely pay it off. So mathematically, there is just a tad more certainty in real estate, and the rates are ridiculously low. There aren't as many people going out there buying real estate 20% if the interest rates are looking like margin interest rates, which if you're getting started and you've got less than $25,000 in margin, you are looking at something really high, like an 8% interest rate. And if that 8% interest rate was in real estate, there will be a lot more people buying their houses in full, all cash, rather than doing it through a mortgage. So that's just some of the stuff to think about with buying stocks with margin. If you are unsure, I would just say stay away from it, but it can be a great capability to have for some people who do pay a little extra attention, and like a 2% decrease won't play with your mind or anything like that. So in any event, I do hope you guys enjoy this video. Subscribe for more content to help you with your investing, and I'll see you guys in the next one.